Okay, class is in session. Today's topic is long-term care insurance. So I try to be very open about my father, and he has dementia and he has an insurance policy. So I bought a policy for Jill and I. And I think it's important that we understand how these vehicles used to work, how they do work. I'm not trying to sell anybody a policy. I don't know you or your unique situation, but I think it's very important for education for people to understand exactly what is out there. So I'm going to start by sharing my father's policy, and then I'm going to turn this board over and show you what I'm doing. My father has a traditional long-term care policy from a company called Genworth. And this policy was sold to him many years ago, before I was even in this business. I would say at least 20 years ago, which is important. We'll come back to that. So what the policy is going to pay $6,000 a month for 6 years for dementia. And I've actually filed a claim because he needs more support now. And I paid $4,000 for him in the last invoice. Now, I don't know what the original premium was, because again, this was before sort of my time. But it keeps going up, and that's one of the problems with traditional care, and why it's offered, but it's not really offered a lot anymore. Companies don't like it, people don't like it. The problem with traditional care is that it's use it or lose it. So however much money is paid into this policy, if he were to pass away unexpectedly, all that money is gone. So people don't like that. And then the other part is that it keeps going up. And so what the insurance companies are doing, because they're such wonderful entities, is so people say, well, I can't pay $4,000 now every 6 months. I can't do that anymore. And then they may think that it's not worth it or what have you. And so the insurance company will say, okay, you can stop paying, but now here's your new benefit. And they make it like this. They go like this. And the new benefit is substantially lower. So that's not such an ideal outcome either. Now, I want to point out one thing here that's kind of interesting. So when we look at when we project into the future for how much a long-term care policy would pay for, we see numbers that are not. We might see a current number. We see a future number. But we're living in the current. So when we did this policy, $6,000 a month might have looked like, I don't know. Is that a good number? Is that a bad number? We don't have a clear view on what the prices might be for healthcare going forward. So we just have to accept the number. I'll show you on the other side the number that I've accepted. But 20 years later, however long, that's actually a pretty good number, because if I have to, as I layer on more care for Fred, 6,000 will go a long way. So it's kind of cool. What you're going to see is, so what I put into my policies, you could put in more. I do have people like that. You can put in less. But the idea is that you just have to you choose a number that's comfortable, and even if your policy pays $2,000 a month in 20 years, that's still money that the insurance company will have grown at a better clip than you can. So this is an old policy. So let's come over here and let's look at the new policy. So I bought a policy from Securian Financial, which is Secure Life, or Minnesota Life. So now I put in $52,000 into this policy, and I did one for Jill for $50,000. So I put $100,000 into these policies. Again, that's what I did, right? If somebody says to me, I have $35K, I have $50K, I have $20K, the benefit is lower, and it certainly depends on how old you are when you start the policy. But still, these are numbers where the benefits end up being pretty good. There's also $4 trillion in America of dead money sitting in savings accounts earning like zero. So when I moved money over, I was moving money over that I had earmarked for care, and it wasn't doing much. So that's kind of lazy money or dead money. Okay. So my benefit is for 6 years, and I chose the 5% compound inflation because I did it when I was 54. So also I had 54 non-tobacco couples discount. So that's just to be transparent. That's sort of how my policy was priced out. I did the compound because we know that inflation is rising. I was willing to accept the benefit in the early years to have a higher benefit in the later years because of inflation. I don't really do a policy like this for anybody that's over 65, I would say. And if you're in the 60s, we usually don't choose the inflation because it doesn't work out right financially. But since I did it when I was 54, I had a little more time. Okay. So I refer to this as live, die, quit. How's that? Live, die, quit. If I die without using any of this benefit, my family would get $50,000, almost the whole benefit back. If I quit the policy in year 6, we'll get the whole premium back. Now let's go back to this death benefit for a second. Remember something. We're not doing this for the die or the quit part. We're doing this for the live part, right, where we might need the care. So, if I were to pass away and my family would have gotten $50,000 back, I mean, they got most of the money back, and I realize it's worth less because of inflation, yada, yada, yada. But still, they got the money back, so it didn't go in the toilet. Now, here's the benefit part. Now, here's the reason why we do this. Here's the benefit part. At age 80, if I need care, it will pay $7,400 a month for my care. It's a big chunk of change for a max of $604,000. So that's the benefit should I need the care. Now, I want to point out one thing to you. This is the important part. Remember, I reference lazy money or dead money. $4 trillion people have sitting on the side. So here's the thing. If I start to collect at this age, the internal rate of return is 8.80%. 8.8% compounded tax-free growth, because if it's used to pay for qualified medical expenditure, it's tax-free. 8.8%. Here's the key. As people age, they get a little more conservative with their money in money investing habits. If I need care and an insurance company has grown my money at an internal rate of return net of any fees, costs, taxes, nothing, 8.8%, then that is outstanding. I cannot do that, right? So to compound with no ups and downs in the market, to invest money for from 54 to age 80, which is 26 years, it's the pooling of risks, because the insurance company, they can do that for you because they will have people that die without needing the care, and they will have had their money. They could have had their money for 25 years growing their money, and then all they have to pay out is this. So they've made money enough to give me a good benefit should I need the care. So that's sort of the game that they're playing and that I'm playing. Live, die, quit. Securian is a company that does this. Lincoln Financial, One America has a great couples product. So again, I'm sharing this information with you for educational purposes only. I'm not trying to sell anybody anything. If you have questions or need help, you can always feel free to reach out. I believe that financial strength comes from education. And while we're on the subject of financial strength, if you like what I'm doing with this channel, Get Financial Strength, now consider liking or giving a thumbs up or a comment or subscribing. This tells YouTube that the content is good, and then they share it with others. Thank you for watching.